By now, you've probably heard of the concept infinite banking. It's using a specifically designed whole life insurance policy to become your own bank, to take back control of your money, and that way the banks don't control it, you control it. You can mimic what banks do and make a ton of money doing it, build legacy, build wealth, and all those things. But what if you can't get a policy? What if you're not insurable? You've got a terminal illness, you're overweight, you've got diabetes, whatever the case might be, you're just not insurable. You cannot get a policy. Good news is you can still practice the concept of infinite banking. My name is Devin Burt. In this video today, I'm going to show you exactly how that works. I've got 15 policies myself. I have taught the concept of infinite banking and set up over 3,000 policies the last few years. So I'm an absolute expert, I would think, at this point, at this concept and how it can be done. So let me show you guys how you can do the concept of infinite banking, even if you're not insurable. Let's check it out. With every life insurance policy, you've got a few characters that are at play in the policy. So with every policy, you've got the carrier. So that is whoever the company is, right? The insurance company. That is the carrier. So that is the first character in the insurance policy. There always has to be the company that administers the policy. Second thing is you have a beneficiary. So the beneficiary is the individual, or it can be a trust that gets the death benefit payout when the insured person passes away, okay? Third person or third entity in this whole equation is the insured body. So this, of course, is the person that is insured. So it could be, obviously, someone has to be insurable. The whole point of this video is to show you how to use the concept without being the insured person. The fourth and the most important person or entity involved in a life insurance policy is the owner of the policy. That can be an individual or it could be a trust. So here's the cool part. The owner and the insured person does not need to be the same person. So traditionally you think of, you own a policy, you're the insured body. That's traditionally what happens. If you get a policy, you own it, it's your policy, you're the insured person. If you pass away, you select your beneficiary, your kids, your spouse, your trust, your church, doesn't matter. You choose the beneficiary, but traditionally speaking, you're the owner and you're the insured person. If you can't get insured, here's the cool part. You can own a policy on somebody else. So you don't have to be the insured person to be the owner of the policy. The owner of the policy has full control of everything, of who the beneficiary is, of the cash value, using that cash value, because that's the whole point of infinite banking, is to use the cash value to become your own bank, as you see above me here. That's the whole point of infinite banking, using the cash value to mimic what banks do. As the owner of the policy, you have full control over that. You just don't need to be the insured person. So I'm going to jump into people that you can use, different individuals, so you know who you could insure if you yourself are not insurable. So let's go over that. Let's clean this up. So people that you can insure are people that you have an insurable interest in. So this could be people like kids. So your kids, you have an insurable interest in your kids, meaning you want your kids to live a long time. The insurance company wants whoever the insured person is, they want them to live a long time. The insurance company does not want that person to die anytime soon, because when they die, they have to pay a death benefit. So the insurance company isn't in the business of just paying death benefits all the time. They want to insure people that they are confident are going to live a long time. So kids, generally speaking, are going to live much longer than someone like myself or someone like you watching the video. Like, I've got 2 kids. I've got a daughter that's almost 18 and a daughter that's almost 2. God willing, they're going to live a lot longer than I will. I'm 40 years old. So insurance companies will gladly insure kids because they're probably not going to have to pay a death benefit anytime soon. And insurable interest means that the person insuring them, so the owner of the policy, has to want that person to live a really long time as well. Hopefully you want your kids to live a long time, okay? It can be people like spouses, okay? Guys, I have policies on my girls. I've got 3 on my daughter, Haley. Her first one was when she was 12 years old. My daughter, Brooklyn, we got her a policy when she was 2 weeks old. As soon as she had a social security number, we got her a policy. That policy is the best one I have. And it's not even the biggest policy. I only put in $10,000 a year, but because of how much runway it's got, she's going to live a long time, God willing. That money has a long time to compound and grow. And policies are all built on guaranteed tax-free compound interest. So I've got policies on my daughters. I've got policies on my wife. So again, you can insure spouses. You could insure family members. So I've got policies on my parents. I'm the owner of all these policies. I own the policies on my daughters, on my wife, on my parents, even on my in-laws. Okay? You can insure people like that. That's an insurable interest. You can insure people like, so family could be brothers, sisters. Immediate family is really easy to get approved. When you start going into cousins and stuff like that, it's a little harder to get it approved. But immediate family, so parents, siblings, pretty easy to get approved. You can also get approved business partners. Business partners, you can get policies on. So if you have a business and you guys are equal partners, most businesses, if they do really well, you've got a visionary, the person that thinks up all the big ideas. And then you've got an integrator, someone who is really good with systems and putting all these big ideas into practice. Visionaries aren't good at that stuff. There's a great book, if you guys want to look into it. It's called Traction. Kind of goes over the visionary and the integrator. So really, really cool book. But that's the thing, is you've got 2 business owners. The visionary understands that the integrator is very important to their business. If that person passes away, that business is not going to do as well. So the owner can insure that other owner of the business because they have an insurable interest. Their business relies on that person being alive. So this visionary wants this integrator in their business to live a long time so that the business can flourish, they can keep growing. So business partners, insurable interest, you can get policies on them. So as you guys can see, if you are not insurable, you can insure other people and still be the owner of the policy. The owner has full control, and the owner chooses the beneficiary. The owner uses the cash value. So you can do this all day long. And what I'm going to do is I'm going to show you guys one of my policies on my daughter Brooklyn, probably the best policy I have, and to show you guys that, like, I'm the owner. I use the policy. I'm the one that's getting all the benefits of it. She's just the insured body. So God forbid she passes away, Our trust gets a tax-free death benefit. But God willing, she's going to outlive me. She's going to outlive my wife. And we can assign the policy to her at some point. So let me show you guys that so you can really see how this works. So check this out. This is a policy on my daughter, Brooklyn. We got it when she was 2 weeks old, and she's almost 2. So I just funded in January, the second year. I can put in $10,000 per year. That's like the max that I can put into this one policy without it becoming taxable. There's something called the MEC 7 pay rule, which basically just states that you can only put so much money into a life insurance contract before it becomes taxable. And it's all based on how big the death benefit is and that kind of stuff. So with life insurance policies for infinite banking, we're lowering the death benefit and overfunding it to get cash value that you can use for infinite banking. You can only do that so much. So what I did is I designed this policy. I designed it. I'm licensed in all 50 states. So I designed it to be able to put in $10,000 per year. That's the max I can put in. I can put in less. I just can't put in more without it becoming taxable. So I can put in $10,000 a year every single year until I think she is 30. I can't go to the next page on this, but I think until she's like 38, something like that. So, but let's just look at the first few years here. I've put in 20,000 bucks. I've got cash value that I can use for whatever I want of about $11,000, a little bit over 11 grand. So I can use that 11 grand to go make more money, which I do, without interrupting the compound growth on the policy. So this policy, it's going to grow by about 5 to 6% tax-free every year, like clockwork, while I use the cash value. So that's the cool thing. I'm basically growing money in two places at the same time. The 11,000 in cash value, it's out working, doing its thing, while the money's still compounding in the policy, tax-free. So what that means is every single year, I have access to more money than I had the year before. So let's look at like year 10, when she's 10 years old, still a kid, very, very young. At 10 years old, I can put in 10 grand. Look at the cash value. It goes from almost 103,000 to 118,000. That's a $15,000 growth on the policy for putting in 10. So what that means is that 10,000 bucks I just put in got a 50% return. I put in 10, the policy grew by 15. So that's a $5,000 net growth for putting in 10. It's a 50% return cash on cash. Crazy. That's only 10 years in. So I'm going to take that 15 grand in cash value, go make more, while the entire amount I've put into this policy just keeps compounding and growing 100% tax-free. So let's look when she's 30. Still very young. 30 is very young. I'm young. I'm 40. 10 years ago, I was very, very young at 30. So at 30 years old, I can put in 10 grand. Look at the cash value. It goes from 603,000 basically to 600 and almost 44,000. So that is basically a $40,000 to $41,000 growth. That is insane, guys. At 30 years old, I put in 10 grand into her policy. It grows by 40. That is a 300% cash on cash return. The net growth is 30,000 bucks because I put in 10, grows by 40. You got to take out the amount I put in. The net growth is 30,000 bucks. I turned 10 into a net growth of 30. That's a 300% cash on cash return that year when she's 30 years old. Now I'm just going to take that money and go make more. Or what I could do is use this to buy her first car. I did this with my daughter, Haley. She's got 3 policies. When she was 16, we bought a car. She's got a job. She makes the payment back to her policy for the same amount she would have paid a bank. So now we're getting all the money back for her car plus interest while the policy keeps compounding and growing. And I can use this policy for anything. Let's say my daughter, Brooklyn, wants to go to college at 18 years old. $10,000 goes in that year. Cash value is about $249,000. So I could start using this cash value to pay for her college schooling. That way, I don't have to pay back some bank interest for her college. I pay my bank back interest for her college. I get all the money back for her college, plus interest that I would have paid to a bank if I borrowed from them. The whole time, the $249,000 keeps compounding and growing tax-free. So even though I'm using the money, it's still going to compound and grow like I never touched it. So that's the concept of infinite banking. You're using a pile of money, which is the cash value, turning it into a loan. So you're borrowing against the cash value. You're getting a loan from the insurance company's general funds, which is basically an advance of this future death benefit. They're letting you use a portion of the death benefit while you're alive. You're using that to go mimic the bank. You're putting it into investments. You're buying a car. You're putting your kids through college. You're buying a boat. You're doing whatever you would normally get money from the bank for, and you're making a spread. That's exactly what banks do. I've got a ton of videos on how the concept works. Obviously, it's simple. You're just leveraging capital at a cost, just like banks do. Banks leverage our capital, the money we put on deposit, at a cost. They pay us an interest, very little. Then they take it and they lend it to other people for more than what they paid us. That's banking. It's very simple. The person they lend the money to pays that back to the bank with interest. They're using our money. So infinite banking is exactly the same. These premiums are your deposits. Think of it as a bank. Deposits in a bank are the capital they can use to loan money out. Premiums are the deposits you're putting into your banking system to build the capital. The capital is the cash value. You're borrowing that cash value at a cost. You're paying the insurance company to borrow that money. Banks pay us to use our money. So it's all the same. You're taking that borrowed money from your policy and you're deploying it to make more than the cost. So if you can borrow this money, this cash value at 5%, which is generally what it is inside of policies, if you're borrowing it at 5 and you take it and put it into an investment where it makes 10, you're keeping the difference, 5%. The whole time, your money's still compounding and growing inside of the policy at around 5 to 6% tax-free. You're just mimicking what banks do with money. It's actually very, very simple. I think a lot of times people try to complicate it because it's different. It's different than what they're used to life insurance being for. I always tell people this though. It's called life insurance, not death insurance. If it's structured correctly, it should 100% be used while you're alive. And that's what it is. This cash value is a living benefit. The insurance company is giving you access to a portion of your death benefit. That's what the cash value is. It's equity inside of the death benefit that you can use tax-free, because loans, they're not taxed. So you can borrow the money, you don't get taxed. Your policy grows tax-free, so you always have access to more. And again, guys, this video was all about being able to do this and not being insurable. If for some reason I'm not insurable, I'm just going to get more policies on my daughter, Brooklyn. I'm going to get more policies on my daughter, Haley. I'm going to get more policies on my wife. I'm going to get policies on my brother, my sister. I'm going to start getting policies on everybody in my family, because one thing you have to really understand is that everyone's going to pass away. It happens to all of us. So if you start insuring everybody in your life, your parents, your in-laws, your kids, your wife, your brother, your sister, your cousins, eventually when they pass away, hopefully it's way in the future, but eventually when it happens, a big sum of money comes in to you as the beneficiary. If you're the owner, you set yourself as the beneficiary or your trust. Now you've got a whole bunch of tax-free capital where you can start really making big moves. You can pay off a bunch of debt that you might owe. You can fund more policies. So the death benefit is something that can make perpetual growth with your wealth. Take, for instance, the way these are structured is the death benefit gets bigger the longer you have it. So with this policy on my daughter, the death benefit starts at $550,000. That's what it starts at. Okay, she's 2 years old, starts at $550,000. As you can see, when she's 3, death benefit's even bigger, $578,000. When she's 4, almost $607,000. By the time she is 34 years old, still super young, the death benefit is all the way up to $2.14 million. It just keeps going up. And the reason for that is because the cash value keeps growing. That's how this policy was designed. It's designed with the cash value as the highlight, the death benefit as the cherry on top. So because of that, as the cash value grows, so does the death benefit. It has to. Otherwise, it's not a life insurance contract, and then the IRS is going to start taxing you like it's an investment. So this is set up properly. That's the importance of actually working with an individual that knows what the heck they're doing. If you want to start practicing this concept, if you want to set up policies on your kids like I have, best policies you can possibly get, because I can assign this to her at some point. If you want to start using the concept to pay your debts off and recapture all that money, if you want to start using policies to grow money in 2 places at the same time, in the policy, guaranteed, tax-free, then use it to go invest it in real estate, crypto, the stock market, whatever you're going to invest in. You're literally having your money run parallel. You're making money in 2 places at the same time. If you're ready to start practicing this concept, check out the description in this video. There is a link where you can watch a free training. At the end of that training, you can schedule a call. You might catch me. I take overflow calls. It might be someone on my team. But we will not sell you a policy. We do not sell policies. We teach this concept. If you understand this concept, we don't have to sell you a policy. You'll want to do one. And since we're licensed in all 50 states, we'll set you up with it. So you don't pay us a penny. You do not write us a check, nothing. We help do everything. And once you fund the policy with the insurance company, they pay us for bringing them business. So I'd love to help you. I'd love to see you really start building your wealth, recapture and recycle your money, take back control of it from the banks, and you do not have to be insurable to do it. So check out that video in the description of this video. If you guys like this, please hit the like button. It really helps the algorithm get this out to more people. If you haven't subscribed to my channel, make sure to do that. Now, if you like this video, I know you're gonna love this one. So check that one out and like this video. Like this video. Like this video. Like this video. Until next time, guys, I love y'all. Peace.